I'm with fund manager of the Courtiers Multi-Asset Funds, James Timpson, to find out what's been happening in markets throughout June. James, hi, please give us some insight.
Hi Leo. Well, the themes that we've seen this year more or less continued into June. So markets have very much been dominated by the large growth-orientated companies such as the big tech companies. The S&P 500 had another good month because of that. The S&P 500 tracks the largest companies in the US, and so far year to date that index is up nearly 17%. But as we've mentioned several times, that index is very much dominated by those large growth tech companies. So the likes of Meta, for instance, formerly Facebook, that's up over 100% this year. And Nvidia, of course, that's up nearly 200%. So even though the index as a whole is up nearly 17%, actually, if you look at the average return of each of the individual companies within that index, the average return on those is actually just under 8%. And in fact, the median return, so if you were to rank all of the stocks in the index from the best performing to the worst performing and look at the one in the middle, the median return is under 5%. So even though the headline figure for the index is way up at 17%, that's very much because it's dominated by the largest companies in the index, those tech companies that I mentioned. So even though it looks as though it's been a great year so far for equities in general, particularly the US, it is just a small number of equities that are driving those headline figures up.
And I suspect, James, with the rally going on at the moment and the percentages shooting up to the likes of 17%, if you suddenly wanted, for whatever reason, to get into those growths, the cost to get into those stocks, even for a short period of time, would be huge.
Yeah, so even at the start of the year, those companies, those tech stocks were very expensive compared to most other markets. But of course now, given this big rally that they've seen, they've just become even more expensive. So now would be an incredibly risky time to suddenly make a drastic switch into those growth stocks because they've just become so pricey.
I think as well, James, that would be irresponsible, especially when it's not your money. And you come up with these long-term strategies for a reason. Obviously, we keep going on about it, the long-term view. But give us some insight now as to the UK and it's underperforming. Why is that?
So that's partly because the UK market has very little in the way of tech exposure, certainly compared to the likes of Japan and the US. But also, certainly in the last couple of months, we've seen disappointing inflation data. So inflation measured by the Consumer Prices Index has come in higher than was predicted, and that's had a negative impact on the UK market, both for equities and gilts. So that's why you've been seeing interest rates just continuing to rise here in the UK. So the UK has underperformed. But what that means is it's also become better value, certainly compared to the likes of the US. UK stocks are considerably cheaper at the moment.
So does that mean that you can spread your investments across a greater number of companies for greater opportunities? What does value mean alongside underperformance?
Well, as the UK has underperformed, essentially it's become cheaper. So even at the start of the year, the UK was offering considerably better value than the US. And by better value, we're talking about things like a company's share price relative to its annual earnings. So the lower the price to earnings ratio, the more value that stock represents. And right now we're seeing much more attractive price to earnings ratios, price to cash flow ratios, and dividend yields in UK and European stocks compared to US stocks. So that's why, if you look at the sort of broad asset allocation in the funds, you'll see certainly compared to the global equity market, which has about 70% in US and just 4 or 5% in UK, in our multi-asset funds you'll see much less disparity. You'll see more than 5% exposure to UK and much less than 70% exposure to US, because the UK represents much better value at the moment.
And these value stocks are basically companies that have the potential to grow well into the future?
Yes, so often you'll hear value stocks as being undervalued, whereas growth stocks you often hear described as overvalued, because you have to pay so many multiples of those companies' earnings in order to get your money back. So
yeah, the
over
time
the
it
long-
takes to get the money back is so much longer time horizon than if you're looking at value stocks.
Absolutely, yes. And over the long term, it's been shown that value stocks offer better overall returns.
James, I know that Gary's been looking, he's put a research note together that we're currently looking at and will be issuing shortly, which demonstrates this with comparisons of two companies. So I think we'll leave it there. We've got quite a bit of insight into what's going on. The growth continues. We continue to stick to the value, stick by our guns, so to say. And yeah, we'll see where we are this time next month. And I look forward to catching up with you then, James.
Thanks, Leo.
Thank you.